Hello, I'm Patrick Grattan of RevereTrading.com. In this video, I'm going to show you how to predict the performance of a stock market strategy. Of course, we don't know for sure what the future holds, but based on probabilities, we can set a reasonable expectation. This will allow us to determine whether we are paying too much in brokerage fees, have enough principal invested, and to know how long to stick with an underperforming strategy before bailing out. Take the strategy shown in blue on the screen. It looks fantastic from here, especially considering buy and hold is in red. But will it perform like that in the future? Let's see what the mathematical expectation is to see. In this spreadsheet, we have the new expected return tab shown here in orange. To use this tab, we first need to fill out all of the green boxes at the top. To get this information from a strategy we've already constructed, we can look at the results output. So the average trade return is shown here, and for this specific strategy, it is 0.28%. So we can set it like that. For standard deviation, it's also shown here. Standard deviation is here, 1.7%. Number of trades per year. Here it shows 7.8 trades per month. So if we multiply that by 12, we'll get 94 trades per year. So we can change that here. The next one is how much principal we plan to invest. In this case, I have $10,000 selected. And the next one is trade cost. This is the cost for a round-trip trade, the fees that your brokerage company will charge you. So if you have a brokerage company that will charge you $10 per trade, it will cost $10 to get into the market and then $10 to get back out. So that would be $20 for a round-trip trade, buy in and sell again. The first thing that we see once we have all of these boxes filled are these bell curves that are constructed. This first bell curve here shows you the forecasted return after 1 year. The red lines is a 90% confidence interval. So we can be 90% confident that our return is going to fall somewhere between that. And the upper limit of the red line is 41% gain, and the lower limit is negative 14% loss. You can also see interest is the chance that a given year will be positive. In this case, there's a 79% chance that we're going to have a positive year. That means there's still a 1 in 5 chance that this is going to be a loss on the year. Despite the fact that this is a pretty good strategy that we have programmed in here, there's still a 1 in 5 chance that it's going to be a loss at the end of the year. So that's something important to keep in mind, that even the best plans or the best strategies can underperform in a given year. Another graph we can look at here is the mathematical expected return of the strategy. And as expected, the purple dotted line shows a positive bias upward as time goes on. And these are actually in trades. So here's 20 trades, 30 trades, 40 trades, 50 trades, like that. So that's good to see. Also on here we have the bounds for the standard deviation. So the blue is the -1 standard deviation, and the orange is the -2 standard deviation. So we can see that for the -1 standard deviation, we're hovering right here on the negative territory. And then for the 2 standard deviation, we see that there's some possibility that we will drop down to 30% loss in the first year and never recover. One of the things that we might be interested in is how long should we trade this strategy if it is underperforming before we give up. And that can be seen right here with the required trades before 84% confidence of profitability. In other words, there's an 84% chance that we're going to break even on this strategy if we trade for at least 142 trades. 142 trades might be kind of a lot to you, and it's important to do this kind of a calculation before you begin trading this. Before you begin trading the strategy, because you may not know this number ahead of time. In this case, we do know the number, and we know that it's talking about 1.5 years that we'd have to trade before we can bail out. That may be just way too long, and so what can we do? And that's when it's important to look at how the principal invested and the trade costs that you are incurring can affect your expected return. If we change to a lower cost brokerage firm that maybe charges $5 per trade, then our round trip cost might go to $10. Let's see how that affects it. So we see we still have a positive bias here on the red dotted line, but you can see that the 1 one standard deviation line is much improved. And even our 2 standard deviation line, even though it does come down here to maybe negative 15%, it does start to recover and come back up. So that means it's more of a sustainable strategy than what we had previously by having the higher cost brokerage fees. In this case, you can also see that the blue line, the 1 standard deviation, crosses the profitability line, the break-even line, after 68 trades. So after 68 trades, there's an 84% chance that we're going to be sitting on a profit. So this is much better. This is only 2/3 of a year, really, that we'd have to trade. So it's much improved. See what else we can do. Another thing we could do is maybe change the principal invested. If we change the principal invested to $20,000, for example, we can see that it pulls the 1 standard deviation line up even further. Now we only need to trade 47 trades, in other words a half a year, in order to be 84% confident that we're going to be profitable on the year. So you can see that there's a trade-off here between the amount of principal you have invested and the cost of your brokerage firm. That's important to put these in here to see what they look like so that you know ahead of time whether you're paying too much or have enough principal invested, or whether you are trading long enough to be able to actually get through any kind of downtrend that you're in. Some people understand this, these theoretical graphs a little bit better when you see it as an example. And so I've included on here a Monte Carlo analysis. And all this does is it takes the average trade return coupled with the standard deviation and simulates 100 times what it might look like in the future if those 2 factors hold true in the future. So here you can see after 100 runs we're getting an average return of 26%, a median return of 23%. That's pretty good. Let's see how that changes if we go back to a $20 round trip and a $10,000 invested. We can run the simulation again, and it will do 100 again. And here you can see we've cut our average return just about in half. We're at 10% in this case, with a median return of 7.9%. So we can see how that actually turns out. You know, for the historical return, we were getting about 14% annually, but when we add in these higher trade costs, we're only getting 10%. So if you don't know that ahead of time, you're going to be surprised when you start trading this strategy in real time. Another thing we might like to know is how much drawdown is reasonable. So if you start trading this strategy and you get, like, say, maybe 10% drawdown on your strategy, you might think, oh, this strategy isn't working anymore. But when you look at this Monte Carlo analysis in this case, you can see that the average drawdown for these 100 runs was 15%. That means that on average you're having a 15% loss, and even a maximum of 37% is very much possible. I just ran another 100 simulations here, and you can see that we still have a 15% on average loss, 32% maximum drawdown. And here I ran it again, and you can see the average drawdown still hasn't changed that much, with the maximum drawdown still around 30%. So if you're hitting around 15, maybe even 20% drawdown on this strategy with these parameters, I would say it's not unusual at all. If you start getting close to 30%, and especially if you exceed 30%, in this case, you would know that it's time to bail out of this strategy, that it's no longer working anymore. So that's one of the things that are really important about calculating your mathematical expectation, is that when you're trading in real time, you can know if what you're seeing is typical or atypical. And if it's atypical, you need to rework your strategy, you need to pull your money out of the markets, you need to do something. You can't stay on the course that you're on. Well, that concludes this video. I hope you found the mathematical expectation calculation to be useful.